Today, we're talking about one of the most important skills for any startup investor, building a deal flow pipeline. Honestly, this is the system that separates the pros from the hobbyists. It's how you turn random chances into a portfolio that actually wins. Okay, so let's just dive right in by looking at the core problem. Think about it like this. Imagine trying to navigate this huge, confusing landscape with no map, no compass. That's exactly what startup investing feels like if you don't have a system. Because that's the dream, right? Finding those incredible, high-potential companies before anybody else. But how do you actually do that consistently? How do you stop hoping a great deal lands in your lap and start systematically finding them? And look, the stakes here are really high. Without a structured process, you're pretty much just relying on luck. You could totally miss the next unicorn because you weren't ready. Or even worse, waste months chasing deals that, honestly, were never a good fit in the first place.
And this is the solution: the deal flow pipeline. It's not just some fancy business school term. It's the professional's playbook for managing the entire investment journey, all the way from that first email to the final handshake.
So, what does this blueprint actually look like? Well, you can break it down into 5 really clear, essential stages. Think of it like a funnel, one that filters thousands of opportunities down to only the very, very best.
First up is sourcing. This is all about filling the top of your funnel with potential deals. Next is screening, which is your quick initial gut check. If a startup passes that, they move on to due diligence, and that's the real deep dive into their numbers, the team, the market, everything. From there, you negotiate the terms, and finally, you close the deal. See? Every single step is a filter, and it's designed to save you time and focus your energy where it matters most.
Now, knowing the stages is one thing, but really mastering the funnel, that's where the advantage comes in. It's about understanding the pure volume of opportunities you need to sift through to find those true gems. Let's take a look at a real-world example from Allied VC. In a single year, they see over 1,500 quality opportunities come through their different channels. Just think about that number for a second. That is the top of the funnel, a huge pool of potential. And out of all those 1,500 leads, you want to know how many they actually invest in? About 7. That is less than half of 1%. This just goes to show you how incredibly selective you have to be and exactly why an efficient filtering system isn't just nice to have, it's non-negotiable. So how do you manage that first massive filter? Well, for sourcing, it's all about diversity. You can't just rely on one channel, and you've got to track your results to see what's actually working. Then, for screening, you need to be systematic. Use a scorecard that focuses on the big things, the team, the market, and how it fits your strategy. It helps you make objective calls and fast. And listen, spreadsheets are only going to get you so far. As your deal flow grows, a good CRM is absolutely essential. I'm talking about tools like Airtable or Notion. They can track every single interaction, automate your follow-ups, and just give you a crystal clear view of your entire pipeline at a glance.
But, even with the best system in the world, there are pitfalls. So let's talk about the common traps that can create bottlenecks and just completely stall your progress. The number one biggest trap: trying to do it all alone. In the venture world, your relationships are everything. Thinking you can find the best deals without a network is a huge mistake, and the data really backs this up.
Just look at this data. A staggering 70% of all VC deals come from network connections, only 10% from cold outreach. The signal here is it's crystal clear. Your network is your pipeline, period. And this just hammers home the need for efficiency. The average angel investor looks at 80 different opportunities just to make a single investment. So if your sourcing is weak because you're working alone, you simply won't see enough quality deals to build a strong portfolio. It's a numbers game. So how do we fix these problems? First, you have to sharpen your investment criteria so you can say no faster. Second, stop trying to do it alone. Join investor networks to get access to deals that are already vetted. And remember to contribute back. Third, you need to think like a portfolio manager. You're probably going to need somewhere between 25 to 50 diverse investments. And finally, never, ever forget the golden rule. Prioritize the founding team. Something like 95% of investors say it is the single most important factor. Okay, so let's bring this all together. We've talked about the structure, the funnel, the pitfalls, but what's the one thing that truly gives you a winning edge in this game? This quote from Chris Dixon at Andreessen Horowitz, it says it all. Read that again. 90% of success comes from sourcing, from building the machine that finds the deals.
The actual act of picking the winner, that's only 10% of the battle. The real work is building the pipeline itself.
So, the most crucial point, the thing I really want you to take away, is this. Your competitive advantage as an investor isn't some magical gut feeling about picking winners. It's the disciplined, systematic, well-oiled machine you build to find, evaluate, and close the best deals. Your deal flow pipeline, that is your edge.
And that brings us to the final question. And this one's for you. You have the blueprint now. So what's the first real tangible step you're going to take to build or improve your pipeline today?